Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week, I'm joined by Paul Metrey from the National Automobile Dealers Association. Paul, thanks for taking the time and joining us here.
Thank you. My pleasure.
I'm excited that we've been talking about a lot of stuff on the podcast, but auto is top of my mind. But I wanted to start with the FTC ruling that you guys are talking a lot about. So give me the background. I'm not an expert in this space. I mean, like a little bit of regulatory, a little bit of auto, but my Venn diagram of automobile regulatory is somewhat limited. So help me understand what's going on here.
Certainly. Well, the Federal Trade Commission, which is the primary regulator for dealers, last June, they proposed a trade regulation rule. They are concerned about consumer protections. They believe a rule that would impose new duties and restrictions on dealers would help to further protect consumers. And we have been very critical of it for a number of reasons. And maybe I can just tick off a few of those for you. And it really comes down to the process that the FTC followed in developing this proposed rule. Also, the support for it. Both of these, we think, were extraordinarily thin. And then, of course, it led to what we think are very poorly thought out substantive provisions. So just to quickly hit on those, from a process standpoint, the FTC was proposing a rule or has proposed a rule that is not directed by Congress. And they did not precede the notice of proposed rulemaking with any type of advanced issuance to inform themselves on the subject matter. So there was no advance notice of proposed rulemaking, no request for comment, no outline of proposals for which they sought comment. There was nothing on the front end to gather information to help inform the rule. In addition, when they put it out, they also had very little coordination, certainly with industry. We meet with FTC staff all the time, but these individual provisions they proposed were never discussed. And we believe even with other agencies that have authority in this area, one area that they touched on have to do with credit disclosures. And for dealer purposes, that's really in the domain of the Federal Reserve Board. It's not in the domain of the FTC. There was no apparent coordination there. And they're applying this on top of a host of existing disclosures, not just under the Truth in Lending Act, but also at the state level. For example, California, they have a requirement that before you enter into a transaction, you would have to make all kinds of disclosures related to voluntary protection products, which were a big focus of this rule. It's not clear that there was really any meaningful coordination with the states on how this would affect them, because even though preemption would apply with a direct conflict, in most cases, there's not going to be a direct conflict. In other words, a regulated entity can comply with both the federal and the state standard. And you really got to think through, if you pile on a bunch of disclosures and other obligations, how is that going to play out? So we believe the coordination was very thin, which was a problem. In addition, the comment period, this was very rushed. It was only 60 days. Now, the FTC will do a 60-day comment period for much less consequential items. I mean, it might be like the extension of a Paperwork Reduction Act request, which is only a couple pages in the Federal Register. This is a proposed rule cut out of whole cloth. So they go ahead, they put that in there. We have 60 days to respond. Naturally, we sought an extension, as did many others, including SBA's Office of Advocacy. And to us, inexplicably, that was denied. It's also surprising because the proposed rule was accompanied with 49 questions and answers, or they were seeking answers to 49 questions. Many of these you would do on the front end to help inform the proposed rule. It was surprising to see that they're in there, but they asked a lot of questions about the impact on business and that type of thing. And we wanted more time to be able to do an assessment. Unfortunately, that was shut off. Also, as I'll point out here in a moment, they propose a number of disclosures, consumer disclosures, and it appears there is no consumer testing of those disclosures. And for any federal agency, that is a very basic step. You want to make sure that if you're going to propose new disclosures to help inform consumers, that they actually are going to serve their intended purpose. And you've got to look at what the effect on the consumer is. So it's very routine for these federal agencies to go ahead and test the effect of a particular disclosure on consumers to see, is this going to enhance their understanding or detract from it? Unfortunately, that never happened. So a lot of steps here were really short-circuited. You know, one thing I would say really highlights this, they did a purported cost-benefit analysis of what this rule would do in the marketplace. Obviously, it's going to cost business money to comply.
Sure.
But they say it's also going to provide benefits to consumers. And the figure they used was $31 billion over a 10-year period. And you might ask, well, where did they come up with that? And is it too complex for us to cover in a short podcast like this? Well, it really is not. because it was done in a very cursory fashion. They looked at three variables. They said, this is going to save these disclosures and everything else we're doing is going to save consumers 3 hours per transaction. They assume that. They say that in the rule, in the notice of proposed rulemaking. That's based on nothing. There's no support for it. They just say it's going to save 3 hours. They then come up with the value of someone's non-work time. So they multiply those two. And then they multiply that by the number of transactions that motor vehicle dealers do with consumers. And they used a greatly inflated figure for that. You take those three variables, it comes out to $31 billion. So it's that thin, it's that cursory, really not well thought out. And unfortunately, that's really indicative of the whole exercise. So on the process side, a lot of concerns, and many that actually go well beyond that.
Can I ask a simple question here? How does the addition of disclosure, not that I want to bash the agency, because you can do that, but I'm going to stay out of that business. But I'm curious how does adding disclosures to a transaction reduce the time a consumer spends? Like, what's the logic behind that?
Well, you would have to ask them that question, because I certainly don't see it. Certainly not in this case when you consider the disclosures. I'll hit on those in a moment, but to your point, I think the only fair estimation is that it would inject quite a bit more time into it when we talk about actually what the disclosures are. So, or
no more time and no more understanding, which is like, I remember when I bought my car, it's not a lot of paperwork, and I hate to admit this on the podcast, I didn't read it all in great depth. And there were a number of disclosures that I definitely put my John Hancock on and said, oh, this is just what you do, right?
Right. Oh, well, and that's the thing. Sometimes it's assumed more disclosures are going to be more helpful to consumers, but that's why they consumer test, and they find out that that's not always the case. You want to make sure that they leave there with a better understanding of the process, and sometimes it requires more, sometimes it requires fewer, but you test them.
Yeah.
And by the way, just one quick footnote on that. The FTC knows how to do this. The Bureau of Economics in 2004 was looking at a HUD proposal in which they said that a mortgage broker, the compensation they earn, that is something that should be disclosed, not just in a HUD 1, not just at closing, but during the shopping process. So they did quantitative testing of over 500 consumers. And they found out that even though it's very well-intentioned, many of them were selecting more expensive mortgage products because they were fixating on this figure and not the overall cost of the mortgage. So they really said they should go back to the drawing board on that. And that's why you do that type of thing. It's just for this reason. You try to figure out, yes, this is well-intentioned, but is it going to enhance understanding?
Does it really help the underlying?
Without a doubt. Now, in terms of the support for the rule, that also, and we've been very critical of this, and we could talk about that for some time, but I'll just give you one quick example. They largely supported the rule with in reference to qualitative testing, consumer testing that was done. And let me just tell you how thin this was. So in 2017, the FTC did qualitative testing of 38 consumers in a single market, the Washington, D.C. market. 19 that had bought new vehicles, 19 that had bought used vehicles. And based on that, they came to some conclusions, and they came out with a report in 2020, which was a very large portion of what they pointed to in support of this rule. Now, as many people know, qualitative testing is not quantitative testing. Qualitative testing is usually used to develop quantitative testing. You measure prevalence through quantitative testing. So they skipped that quantitative step, and they used this to help support the rule. And there were problems with it beyond that. The survey design plan for the qualitative testing had a lot of flaws in it. And even more to the point, the report that came out in 2020 on this qualitative testing, it stated that it is not suitable for generalizable conclusions. And of course, we know that our rulemaking is an exercise in a generalizable conclusion. You're applying something to an entire marketplace. It's not targeted at any one person. So real concerns with the support for the rule. Now, to your point about, what's in it, and is this actually going to speed up or slow down the process, or what effect is it going to have? Well, the rule does several things. It's very broad. I'll get to the disclosure piece, but initially they said that they are going to prohibit certain misrepresentations. Of course, misrepresentations are already prohibited. They're doing this to confer upon themselves the ability to fine a dealer over $50,000 per violation. And the real concern here is the clarity with which they defined the misrepresentations. Obviously, there are certain things out there that should never happen and should be penalized. But the way that many of these things are worded, it's unclear what a regulated entity can or cannot do. And when you now have fine authority of over $50,000 per violation, remember, these are dealers, not banks. So the capacity to be able to assume or absorb these violations would be much more difficult. That is an issue. They also prohibited the sale of valueless, quote unquote, add-on products. Well, of course, no one should sell a valueless add-on product, but it's very poorly defined, particularly in areas like gap waiver. They have real concerns about the value that a gap product would provide to a consumer. Well, of course, there can be extraordinary value. We've seen that over and over. But the way they define it is a big concern. So they've done that type of thing. They have new advertising standards that would apply to dealers and only dealers, not other regulated entities. But then to the point that you hit on, which is disclosures. Here's what they've required to happen in any type of transaction. A few things. They say anytime a consumer inquires into a specific vehicle, or for that matter, a monetary term or any financial obligation, upon the dealer's first response, the dealer would have to provide the offering price. Now, the offering price is everything except for governmental fees. Now, you have to do that whether the inquiry comes in writing or it comes in orally. So that means if I'm a salesperson and you run into me at the bowling alley and you make an inquiry into a specific vehicle, upon my first response, I have to provide that information. It could be you're using the chat feature on our website. It could be a text message you send. You could be in the showroom. It could come up from a variety of different ways. And when you think about it and the liability that attaches to these violations, trying to make sure that you're actually providing an offering price on the first response when this can come up through so many different channels is a real concern. And one has to wonder, what's the value of it? You know, if you think about it, the first time you and I speak, if I had to give you the offering price, I'm not going to know if you qualify for certain rebates. I'm not going to know if other discounts are applicable. So I'm probably going to default to something like the MSRP, which is higher than what you're going to end up getting. So you'd have to ask, what's the purpose of the disclosure if you're going to have something more favorable? So they've done that, certainly having to do those disclosures every time someone inquires into a specific vehicle. And a customer can ask about 2, 3, 4, 5 vehicles. Really ties up the process. But even more so, anytime that a dealer would sell a voluntary protection product, they would have to get from you up to 4 additional written disclosures. So that is certainly a time-consuming exercise. And there's other concerns with it. I mean, they use terms in there like cash price that differ from the way it's defined in the Truth in Lending Act. So there's just some inherent confusion with it. We just don't think this was well thought out. We think it would build a lot of time into the process. They've also said with websites, a dealer would have to go ahead and identify all of its voluntary protection products and the price associated with it. Now, that might sound pretty benign, but consider how they define a voluntary protection product. It's really anything that's not put on the vehicle or sold directly by a manufacturer. So when you think about it, any part that comes with a vehicle is something that is considered to be an add-on product that you would have to separately disclose with pricing. Now, dealers sell hundreds and hundreds of potential parts and accessories with vehicles. This is a requirement that would require, when you consider all the different products they sell, probably over 10,000 separate line item disclosures with pricing. And you have to ask yourself, is that enhancing consumer understanding? And if what you're really trying to get to is like the price of a prepaid maintenance plan or gap waiver, is that going to be something that's salient and available to a customer when you load it up with all these other disclosures? And the other quick point on that is, if you're a manufacturer like Tesla or Rivian, even though you can be considered a motor vehicle dealer under this particular proposed rule, you would not be subject to that disclosure requirement because of the way they define an add-on product. You know, you're the manufacturer, you're putting the product on the vehicle, you're selling it directly. So they say they want to level the playing field between regulated entities, but here they've driven a wedge into it. And the last quick thing to comment on is record keeping. They would require dealers to keep a slew of records for 25 months, records of all those communications I referenced, among many other things. And that's unfortunate because they say that they're really trying to protect the honest dealer. You know, I'll tell you, the FTC over the last 10 years has taken 37 enforcement actions against auto dealers. They would be requiring here tens of thousands of dealers to keep a huge cache of documents. In the unlikely event that there's an enforcement action, when none of their current enforcement actions, to our knowledge, have suffered from a lack of documentation. So really, we think it's not something that's helping the honest dealer. It's hugely burdening the honest dealer. And if there were a good cost-benefit analysis, that would come out. So a lot of concerns with it. Again, a poor process and very poor support, and we think it's led to something that's not going to be helpful.
Yeah, I think your point of view is pretty clear on this one. Yeah, you've not been shy. I'm curious when I hear a story like that, and obviously I'm sure there's a different perspective on it somewhere, but do you have an underlying sense of what's driving the agency to move as quickly as they are towards something that is not like, what's the driver for moving this thing through so quickly without some of the more traditional analyses, cost benefit analysis, more rigorous quantitative studies, consumer testing of disclosures? Like, is there a driver for why that's not being done, do you think, in this case?
Well, they have a very aggressive agenda. There's all kinds of things that they have expressed concerns with, and they've launched rulemaking with, for example, as you may have heard, non-compete clauses. They propose a rule to eliminate those. By the way, not just with existing employment contracts, but future ones, and there's a notification requirement. So they're very disposed to try to go after a lot of things through the rulemaking process. And here they feel that they need to address concerns in the marketplace. You know, it's odd to us because none of the things they're addressing lack remedies today if there is some type of abuse. So they really do not have to plug any type of gap. So we think it's definitely overkill. We don't think it's well thought out. And we think if they did go through that more deliberate process, they would find that many of the things they propose really are not warranted.
Let's shift a little bit from rulemaking, such an exciting thing, to enforcement actions, because there have been a number of enforcement actions or lawsuits from attorneys general in the auto dealer, auto finance space recently. What's your take on what's going on out there? Like, I mean, you can go into some specifics or just generally, like, what are the kind of trends that you're seeing? Because it's been like, I feel like I open up the paper and every now and then I'm reading a more frequent set of headlines in the space than typical.
Sure. Yeah, certainly. Well, the FTC has one area they're very concerned about is the exercise of pricing discretion. And certainly pricing discretion does have to be managed. You want to make sure it's not done in an arbitrary fashion or something that could lead to discrimination. So that concern is certainly a genuine concern, although the measures they've taken to address it, we think, are also poorly thought out. But really, you see in these enforcement actions that there is concern about pricing discretion. And in one of the actions last year, it was almost a year ago, it was against a large dealer group. They had stated that they're looking not just at pricing discretion as it relates to dealer participation, so the dealer's portion of the finance, but also they're looking at other products that are sold, you know, some of these voluntary protection products. And that's not something we're aware of having happened in the past. So they are applying it to that. They did that again in October in another action where they looked beyond simply credit. It was beyond simply dealer participation. And also the Massachusetts Attorney General under state law actually just took an action this year that involved voluntary protection products based on a violation of state law. They had looked at whether or not the pricing was done fairly. So there's a lot of focus on the exercise of pricing discretion. Certainly a lot of focus on voluntary protection products as it relates to things like disclosures and consumer consent, those type of issues. They've been very focused on that. Another thing the FTC also has done is they have imposed individual liability in a number of these cases.
Really?
So it's not just against the corporate entity. In that case from about a year ago, they took action against the general manager of 2 of the stores of this dealership group. That was in addition to the corporate entity. And then in October, they actually took the action against the owner of the dealership group as well as the vice president. So that's a trend that I think we'll continue to see in many of these actions.
Are you seeing, I know that there's this interesting dichotomy between the regulations that apply to the dealer in terms of the financing of the vehicle, and then the regulations that apply to the entity, often a bank, that ends up purchasing and owning that contract over the longer term, right? It's usually a RIC that's originated at the dealer and then purchased by a bank that has maybe a different set of fair lending standards testing that's being done. And I'm curious if you're seeing, as these things happen, any reaction from the lender side in terms of their comfort working with dealers, how they're thinking about managing the risks that they have on their side of the house as these kinds of questions are being raised. I think it changes the dynamic a little bit.
Absolutely. It's a great question. So most of the federal laws that are out there are applicable to both entities. So the dealer is the initial creditor and then the bank is the assignee creditor. So Truth in Lending Act and Federal Consumer Leasing Act, Equal Credit Opportunity Act, Graham Leach Bliley, we could go right down the line. These are things that apply to both, although the liability standards can differ. And also, there is this FTC holder rule, so that somebody who holds a contract would be subject to the same claims and defenses that were initially available against a dealer. So they do sometimes look at that from different ways. But in terms of ways to mitigate these concerns, we have come out with a program. It's an optional program because it gets into pricing, but it's based on DOJ consent orders on this whole issue of pricing discretion. We have one that pertains to dealer participation, another one that pertains to voluntary protection products. And those are ones that we believe can be very helpful. And actually, they've been referenced many times. So, for example, that action the FTC took against the dealership group a year ago, they actually said that on a go-forward basis, if the dealership is going to earn dealer participation, that they would need to adopt a program that's similar to the optional program that we developed, that's modeled on that DOJ approach. And then even in October, the dealership had actually adopted that program, but they said they did not properly implement it. So they did not make that an option available to them. So there's definitely been a focus on those types of mechanisms. Yep. And then the Massachusetts AG actually, with regard to our voluntary protection products program, stated that on a go-forward basis, the dealership would go ahead and could adopt that program by name to help mitigate concerns about the exercise of pricing discretion. And we have found that many banks find a lot of appeal in that. They think that, if you have something that's allowing consumers to benefit from appropriate discounts, not based on a prohibited basis, but otherwise is kind of standardizing the process, making sure there's more consistency, it's a good way to keep competition in the marketplace alive, make sure it's based on appropriate factors, and otherwise kind of smooth out what otherwise could be differences in the pricing.
Got it. Interesting. Any of the other recent enforcement actions come to mind when you think? I mean, there's also the case in New York, isn't it? The CAC case.
There is one against Credit Acceptance Corp. That's correct. Now, that's not against dealers. They certainly reference dealers in that.
But dealers are like the Dealer Act. Again, I think that one's centered on some of the pricing discretion and who's getting ultimately liability for.
Right. They do take a look at that. Now, of course, that's a little different from some of the other things we talked about because that actually is not a consent order. That's a lawsuit.
Yeah.
Credit Acceptance is responding to that. That will be settled in court. So we'll see where that goes. Those other ones are all consent orders, so a little bit of a different.
I prefer a consent order, I think, to being sued by an attorney general. I'm not sure where. Neither of those sound like fun experiences, to be honest. There are state-level regulatory action. We talk a lot about the FTC, but what's happening at the state level from a regulatory actions, rulemaking point of view, other than the enforcement actions? Are there other trends or things you're seeing going on that are impacting the space?
Well, certainly a number of states have been very active. We've certainly seen that with things like gap waiver. California's had some legislation. But I think it does underscore a point. And this is something, by the way, on that FTC rule, we filed very extensive comments. So anyone that wants more detail on that can look at that. But really, the states really do have and it differs from location to location, but they really have a very robust regime of requirements that apply to voluntary protection products, to the sales process generally, to things like gap waiver. And those really are in place, and we do see activity with that. So that trend is still there. That tends to pick up, generally speaking, and certainly there has been some enforcement there as well.
I would love to get your take on most of the listeners of this podcast are on the banking side of the house, not on the dealer side of the house. I'm sure there's a few dealers who pop in now and then, but when you think about, the totality of what we've been talking about and how that impacts how banks should be thinking about their relationships with dealers, their relationships to the auto finance side, what should they be thinking about keeping their eye on over the next couple months or the next year or two as they're thinking about how do I support my local dealers, but also manage my risk as a related party, but not directly in the dealership space?
It's a great question, and I think some of the areas that are really very important, I think we've touched on. Certainly, the exercise of pricing discretion to really engage the dealer to make sure that is something where the way it's being applied is structured, and there is an approach to it that is going to protect the consumer, the dealer, and the bank, of course. That's very important. And then things like gap waiver refunds, there's been a lot of discussion on that. That's really something that you could have multiple entities involved in the process. You certainly have the bank that is servicing the agreement. So if you do have something like a default, a repossession, a prepayment, that's something where the bank first learns about it. But there's other circumstances where something can be canceled, and it really requires good communication between the dealer, the bank, and oftentimes the program administrator for the particular product. And doing that to try to make sure that the consumer is made whole, that any refund rights are actually exercised and fulfilled, any obligations are met, is very important. So those are two of the areas that we think are particularly salient.
All right. And then I'm going to ask you one more question, which is I'm kind of curious. We talked a lot about things that are going on that are, we don't like, or rules we think are really interesting. But I want to give you a chance to switch to the positive side. And like, what are the, as the Association of Auto Dealers, like, what are the trends you're seeing that are positive, that like changes in the market they're positive to the consumer, positive to the dealers, things that are like, where's the future headed, not just on the regulatory side, but in general for the space? 'Cause it feels like actually a quite exciting time. I mean, it's been a very weird time over the last couple of years, like lack of inventory and like, a lot of dealers struggling with just, too many salespeople and not enough cars to sell, not because they couldn't get them. And I feel like that combined with digitization, it's a really fascinating time for the space in terms of how the car buying experience is going to shift. So give me let's end on a more positive trajectory. Like what are the positive trends you're seeing in the space?
Yeah, another great question. I mean, there certainly are many positive trends. We are seeing just in terms of online engagement with consumers, we're seeing as consumers get more and more comfortable with shopping and learning about products and they're online, the ability to provide them quality information, clear disclosures, kind of give them a really good snapshot of what's going on. That gets stronger all the time, and that's a great process. More broadly, when you look at kind of the trend with EVs and that type of thing, I mean, that's something that dealers have been very supportive of as consumer demand for EVs goes up. So certainly they are working with the factories to try to make sure that demand is met. As for inventory and the supply chain disruptions and some of those challenges, yes, that's, trying to make sure that you can meet consumer demand and their expectations in that regard. That is kind of an evolving situation, but there seems to be a little bit of easing with that where in terms of, some of the supply chain shortages they had before have improved. It's not something that happens overnight, but I think we're certainly seeing that. And as for the transition to EVs, a lot's going on there. Factories are certainly trying to build more EVs into their fleet. They're trying to get more of a charging infrastructure in place. And different factories are going about that different ways. But certainly dealers have been at the forefront of trying to make sure that happens. One thing we've always stressed, our dealers are indispensable to that process. Because at the moment, the EV purchasers tend to be in your more urban areas. It's ones where the income level might be much higher. But when you talk about a fleet that's mainly, if not exclusively EVs, then you're talking about mass market penetration and trying to make sure that consumers understand this. Their concerns about range anxiety are addressed, and actually you can sell them. They understand the benefits to them. Doing all those things can be a real challenge, and having, in our case, a network of over 16,000 franchise dealers in the local communities to kind of guide them through that process and support it, we think is indispensable. And so we're excited about that prospect, and we think it's very necessary. Excellent.
Well, Paul, thanks for taking the time and joining us today. That was a lot to cover. I learned a lot. I'm sure the audience did as well. And I appreciate you making the time and sharing your perspective.
Well, thank you so much. Pleasure to be with you.